We already have the momentum. So I'm going to keep pounding the table that the best thing for Bitcoin is a continuing credit problem, which I don't think can be resolved on itself. And at the same point, having a commodity a bull market, which is based on scarcity, and then a shorting of abundance, which is based on these growth assets. If all of that plays in,
Bitcoin's like uniquely positioned.
It's uniquely positioned.
Yeah.
I think Bitcoin's going to explode out of here once we get to the realization that the Fed is going to be focused on the deflation side, not on the inflation side. And these two forces are going against each other right now.
The Iran conflict has been escalating fast since it began 3 weeks ago. And this week, it may be reaching a turning point. After renewed attacks on energy infrastructure in the Middle East, President Donald Trump is now openly threatening to strike Iranian power plants if the Strait of Hormuz is not fully reopened. Supporters of the administration say this is necessary to protect global trade and American energy security, while critics warn that any further escalation could send oil prices sharply higher and push the global economy closer to recession. But regardless of where you stand politically, one thing is becoming clear. The economic consequences of this war are already showing up in real time, from gas prices at the pump to rising costs across the entire supply chain. What makes this moment different from previous geopolitical crises is that markets don't seem to be reacting the way people expected. In past conflicts, investors immediately rushed into safe haven assets, but this time the signals are mixed. Oil is rising, credit conditions are tightening, inflation risks are coming back, and yet growth stocks are still struggling to find direction. According to veteran macro investor Jordi Visser, this kind of environment is exactly what you get when the financial system is caught between inflationary pressures from commodities and deflationary pressures from a slowing economy. And historically, those are the conditions in which major shifts in capital allocation begin to occur. In his latest discussion with Anthony Pompliano, Visser argues that the current combination of war risk, tightening credit, and a possible Federal Reserve policy pivot could create one of the most unusual market setups in years, one in which traditional assets underperform, liquidity becomes scarce, and Bitcoin benefits the most. Before we get to his full breakdown of what's happening right now with oil, inflation, and recession risk, make sure to like the video, subscribe to the channel, and let me know in the comments whether you think this war will push markets higher or trigger the next big crash. Thanks, and enjoy the video.
I don't think people are looking at the facts. So forget the amount of drones, forget people forecasting when this is going to end, when the strait will be open. Nobody knows that. And as far as I'm concerned, I care about the facts. Gas at the pump is now $3.92 as we sit here this morning. It started this journey at $2.80. So this is $1.10 on $2.80. That's a fact. Diesel prices are up $1.50. If you go look at what happened at the time that CPI went up to 9+%, this is a faster move than what happened back then for those. Oil prices, you put on the evening news, they tell you oil's around $100. That's not true. The facts are that there's a lot of oil prices. Oil prices that go to Asia hit close to 170 this week in terms of Oman and Dubai, 130, 170. Brent is way above where WTI is. So I think people are paralyzed. I think institutional investors are paralyzed. I think the sell side is paralyzed. And I think there's a very important reason for it that gets into my handicapping days at the racetrack. Why does a horse go off as the favorite? Well, it goes off the favorite because of the most recent results that happen. So when the Kentucky Derby comes, the guarantee will be the horse that is the favorite pretty much won its last race leading into it. Probably won its last 2 or 3 races leading into it. Probably has the fastest speed. There's a momentum thing of this is the highest probability. Well, last year we had the tariff fears at this point. And I posted something today because we are 3 weeks post the beginning of this disruption in Iran. And there is no sign based on the facts, meaning the price is going higher. There was a major attack on Ras Laffan yesterday in Qatar. It's responsible for over 35% of helium. Helium is a major component of semiconductors. Semiconductors are the most owned part. Most of my portfolio is in semiconductors. So if all of a sudden you get a change in kind of earnings estimates, you could have a problem. And this is where I want to just leave people with this. Last year, when the tariffs came out, and you and I said everyone was panicking. I think we have the complete opposite. This is like a George Costanza do the opposite moment. Nobody's panicking. Yet the facts are that we are actually seeing inflation that will filter through. We will see incredibly high inflation numbers. And it's not just from gas at the pump. Oil is in everything. And I think everyone knows that. So when you hear people say, well, the US is now a net exporter of this and that, and we produce so much natural gas, that's true. But we also import a lot of things, plastics and polymers and fertilizer and things that go into other components. And all of those spot prices have gone through the roof. Batteries, semiconductors, everything. So the longer this goes on, the more we're getting closer. And this will be the trigger point. When you start seeing estimate revisions come down, and the reason they're not coming down yet is because last year they came down and they were wrong. And this gets back to the handicapping thing. The recency bias is we changed our S&P target last year for tariffs. We're not doing that again. We changed our estimate revisions for EPS. They were so wrong on the earnings last year for the S&P. We're not doing that. Institutions that sold the market on the fears of these things. So I think everyone is paralyzed trying not to make the same mistake as last year. Iran had a tax this week on energy facilities in the Middle East. And they accomplished it. They clearly can do this with little drones, not with missiles. So the thing I worry about again is not that this is, like all situations, this will end in 3 months from now, 6 months from now, we'll look back and realize this drove things higher. I think when we move a few weeks out, you will start to see the probability of an increase in a recession. And I just want to emphasize, I've been fairly negative on this podcast because of private credit, because of the financial stocks. All of those things were happening long before inflation expectations went higher. We started pricing out Fed cuts. 2-year rates have now gone up sharply. Like, these are other issues. So financial conditions, that magic phrase that you hear people talk about, credit spreads are widening, oil prices are going higher, the dollar's going higher, stocks are going down. All of these things are saying the same thing right now, which is be more in cash. Let's be patient with this. And there are times where you don't want to be offensive with investing. And I think this still remains one of those times to be defensive and to wait for better prices.
One of the key points Visser makes in the first part of the conversation is that investors may be underestimating the seriousness of the current energy shock. While headlines focus on military developments, the actual data is showing something else. Gasoline prices rising quickly, diesel costs jumping, and global oil benchmarks moving much faster than they did during the inflation surge that pushed CPI above 9% just a few years ago. In his view, markets are frozen not because the risks are small, but because investors don't want to make the same mistake they made last year when they reacted too early to tariff fears and ended up being wrong about earnings and growth. That hesitation, he says, could be dangerous if the conflict continues to disrupt supply chains, energy flows, and semiconductor production. And this is where the conversation starts to shift from geopolitics to macroeconomics. Because once higher energy prices feed into inflation while credit conditions are already tightening, the Federal Reserve ends up trapped between two bad choices: keep rates high and risk recession, or ease policy and risk another wave of inflation. According to Visser, that kind of policy dilemma is exactly what creates the environment where liquidity becomes the most important factor in markets. And when liquidity becomes the story, the assets that benefit are not always the ones investors expect.
So there's a few things that are interesting. So since the war started, Bitcoin is, I think, the best performing asset by a good amount too. Gold has now fallen sharply, and I think it's down 8 or 9% since the beginning of the war, and Bitcoin is up 5 to 6 since the beginning. Which is an interesting dynamic on itself. Now, I said it last week, I'll say it again. Some of this is just mean reversion, meaning gold had outperformed significantly. But I do think there's a couple things going on with inside the Middle East. You've got the UAE focused on liquidity for the banking system. So they're already having to pump money into the system. We do have an inflation issue that has picked up. And even though gold is a good theoretically inflation hedge, not if it means rate cuts are going from 0 to up. Bitcoin already discounted this, so it already got ahead of it. If we're going to have a recession and private credit is going to become a bigger issue, then I'm going to go back to my thesis for Bitcoin, which is they're going to have to do something to provide liquidity to the system. If you can't get the oil price down, I hate to say it, guys, but if private credit is worsening, they're going to have to do something for private credit. I wrote about it last week. I'll say it again. This is my belief that the 1970s are the most important thing for Bitcoin, not in the fact that inflation in the 1970s was high. We all know that CPI got up to higher levels than in 2022. Then it came down, then it went higher again, then kind of went sideways. It just never died. We could be in a 3-year period where now that oil prices are no longer sitting there, and I think we're in a commodity bull market, where we could have headline inflation stay high, core inflation for services could come down because of the deflationary pressures on AI. The deflationary pressures on AI are crushing software, and they're crushing anything built on code. And like I've said, if you at the end of this year are sitting there and you realize that the S&P 500 was unchanged or down slightly, and next year there's not a lot of hope for anything changing because we're still in a commodity bull market and people are like, what's going on here? We've got a credit problem, we've got this. Then all of a sudden people are looking for growth assets and they look around, and I think Bitcoin will be the best performing asset this year when you put it in the growth bucket. And if that's the case, we already have the momentum. So I'm going to keep pounding the table that the best thing for Bitcoin is a continuing credit problem, which I don't think can be resolved on itself. And at the same point, having a commodity bull market, which is based on scarcity, and then a shorting of abundance, which is based on these growth assets. If all of that plays in,
Bitcoin's like uniquely positioned.
It's uniquely positioned.
Yeah.
I think everyone should care about this topic because I'm saying that Bitcoin's going to come out of this as the asset that macro funds and everyone needs to add to their portfolio as we get closer to the end. You just brought up a topic which I completely agree with, which is we are going to have a pivot in the globe where the Middle East now, which is in chaos, what do you want to hold and store? Gold. There's rumors that the reason gold has been falling is because Middle East sellers have shown up. Whether or not that's true, I think the love affair with gold for India, for China, for the places there, relative to Bitcoin, when you already said something, they're already involved in this, but they're also involved from a sovereign level of really buying into AI. This dynamic of the way people think of Bitcoin with inside the world, this conversation wouldn't have happened in 2022. And there's a reason why I'm going back 2022. 2022, Wall Street hated Bitcoin. We didn't have the ETF. We didn't have the Genius Act. We didn't have clarity sitting on the edge. Like, we're in a different time period.
And bankruptcies were rampant. It had fallen
exactly
80%, et cetera.
And we had all that money that had been printed in. The reason why I bring that up, if there was no Iran war right now, what we'd be focused on a lot more is the next Fed chair. Mm-hmm. So I just want to bring this up to people. We're in a very different situation we were in 2022 for a very important reason. We still have massive debt that was created post-COVID, but the money supply stimulus side is gone. The credit side is in a very big downturn, and we have AI now sitting here. This is the reason why I want to say to people, we have a deflationary force of AI sitting in front of us on one side. We have headline inflation that is going to be higher for the next 3 months related to all these things on the hardware side. And we're going to have a new Fed chair that is going to have to ignore headline inflation. We have someone coming in. And so this to me is an interesting dynamic where on the one side, this administration has been very clear. We are not focused on inflation today. We are focused on inflation in the future, which is going to be like the 1990s. I can't think of a better scenario for Bitcoin. I really can't. And I think it would be more of a discussion if the war wasn't going on, that a Fed chair was coming in. I still don't think at this point people will be focused on Bitcoin. The reason I think the focus has to be on Bitcoin is because the first part of the year was the software destruction. Mm-hmm. And it made people realize I can't depend on these growth companies the way I did. And all long duration assets are under attack. And I will keep saying it over and over again. I believe liquidity is going to become a real thing. I think liquidity for people is a major story. We're seeing it in private credit. We saw it with the endowments last year. If you want to generate returns, you need to get the liquidity back. That's why tokenization matters. All these things are very positive for Bitcoin because it's a 24/7 daily liquidity product with volume. I think Bitcoin is going to explode out of here once we get to the realization that The Fed is going to be focused on the deflation side, not on the inflation side, and these two forces are going against each other right now.
Visser makes the argument that the market may already be starting to price in that shift, and the evidence he points to is the performance of Bitcoin since the conflict began. While gold initially moved higher, it has struggled to hold gains, and at the same time, Bitcoin has quietly outperformed most major assets. He believes this is happening because investors are beginning to think less about inflation in the traditional sense and more about liquidity, specifically whether central banks will eventually be forced to step in again if credit markets start to break down. In past cycles, that kind of intervention has almost always pushed capital toward assets that can move quickly and trade globally, and in today's market, Bitcoin fits that description better than almost anything else. Another factor he highlights is the possibility that the world is entering a period that looks less like the last decade and more like the 1970s, where commodity prices stay high for long periods while economic growth slows. In that kind of environment, stocks don't always deliver strong returns, bonds become unpredictable, and investors start looking for alternatives that are not tied directly to corporate earnings or government policy. Visser's view is that if oil stays elevated because of the Middle East conflict, while at the same time credit problems continue to build in private markets, the pressure on the Federal Reserve to support the system will eventually outweigh the pressure to fight inflation. He also points to a structural change compared to previous cycles. In 2022, Bitcoin was coming off a crash, institutions were skeptical, and the regulatory environment was uncertain. Today, the situation is different. There are ETFs, there is more institutional participation, and there is growing discussion about liquidity, tokenization, and 24-hour global markets. If the next phase of this cycle is driven not by easy growth, but by financial stress and the need for flexible capital, he believes Bitcoin could end up being treated less like a speculative asset and more like a necessary one. That's why Visser keeps coming back to the same conclusion through his analysis. If the war continues to push oil higher, if credit markets keep tightening, and if the Fed eventually has to choose supporting the economy over fighting inflation, the result could be a market environment where traditional assets struggle, but Bitcoin gains momentum. And in a cycle defined by scarcity in commodities, abundance in technology, and uncertainty in monetary policy, he believes Bitcoin may be uniquely positioned to benefit from all three at the same time. If you found this breakdown valuable, the best way to support the channel is simple. Hit the like button, subscribe, and turn on notifications so you don't miss the next video. I spend a lot of time researching these interviews, digging into the macro context behind them, and bringing you insights from some of the most respected voices in global markets so we can all better understand what's happening in the economy and where things might be heading next. Thanks for watching.